Liquidity shortage and repo market stress gets even worse. Now, the highest spreads going back to 2019, and bank stocks plummet on fears of a devastating credit event, too. So, to start with the banks, before we get to the repo market and SOFR spreads, which are now the highest going all the way back to 2019, I want to start with the banks. I am not a bank expert. I'm not a loan expert. This is not an area of the markets that I pay a ton of attention to, but I did want to give an update because there are some major massive moves going on in the regional banks. As we can see on the left, yesterday, this was starting to trickle into some of the large cap banks as well. We can see, for example, Citigroup down 3.5%, Capital One down 5.5%, Goldman Sachs even down 1.3%, JP Morgan down 2.3. You can see that it is widespread. However, it is the most concentrated in the regional banks, specifically from what I've been able to gather, two of them. Zion's Bank Corp, and I put a little note here, they're based in Utah, although they do have branches elsewhere, like the California Bank and Trust. They focus on commercial and industrial lending. Now, of course, commercial real estate has been one of those areas of weakness that many people have been watching. They disclosed a $50 million charge-off on two bad loans tied to alleged fraud, suing to recover $60 million. There are broader concerns, including consumer lending challenges. Again, we know the consumer's not doing too well, and CRE exposure. We know CRE, commercial real estate, has been pretty weak also. So here's the KRE regional bank. We can see it was down sharply. I do want to note, on a daily basis, on a rate of change for the day, this was the highest going all the way back to, of course, Liberation Day in early April. But before that, the only other time that you saw a daily move to this magnitude to the downside was going all the way back to the regional banking crisis, of course, of 2023. If we go to Zion, it is the same story. In fact, the daily move that we saw to the downside in Zion's was actually the worst, going all the way back to that regional bank failure, of course, of 2023. So the magnitude of these moves is certainly worth paying attention to. Now, the other bank was Western Alliance Bank Corp. They're based in Phoenix, regional bank with a heavy non-deposit funding institution loan and exposure to auto consumer sectors as well. Remember, the lower leg of the K-shaped economy has not been doing well, of course, and that is going to affect generally the smaller banks. You have Capital One, for example, which is a larger, at least in terms of market cap, they are a larger lender, but they tend to focus on lower credit score ratings. But you see that also with the regional banks as well. So they revealed fraud allegations against a borrower. This was part of the First Brands and Tricolor issue, suing for over $100 million. No change to the 2025 outlook, but hefty NDFI loan book under scrutiny amid rising bad loans. So remember, one of the ways to watch this sort of thing is LQD over HYG. This is investment grade corporate bond ETF over high yield corporate bond ETF. So it's kind of a proxy for credit spreads. Now, the best way to measure it is, of course, the B of A high yield option adjusted index, but that only updates once per day. So this is a higher frequency way to keep an eye on credit spreads. I would watch this and, of course, these two regional banks and the KRE, which again is kind of a broader ETF for all the regional banks. I would watch this space for sure, because, of course, if bad loans start to get written off, that can affect the profitability or solvency of these regional banks. Well, some of these regional banks have ties to private credit, so there is risk of contagion for sure. Jamie Dimon at JP Morgan just called it the cockroach problem. So I would definitely keep an eye on the credit markets, on credit spreads, and I would also keep an eye on these regional banks. There is concern spreading into the broader equity market. Even the S&P 500 futures were down quite sharply earlier this morning. They have recovered a bit of those losses. Now, getting to the repo market, as we see, we are finishing out the week. It is Friday. So now we can look at the weekly spread of SOFR minus the reverse repo. On a weekly basis, this is the highest spread going all the way back to July of 2019. So it is getting even worse by just a basis point. As we can see, SOFR continues to blow out over and above the discount window rate, now 5 basis points above the discount window rate. And of course, yesterday we covered that the Fed's emergency backstop facility, the SRF or standing repo facility, this got tapped yesterday for $8.35 billion. So what we have is a transition from a regime of abundant liquidity into one of a shortage of liquidity. And one way of kind of looking at that or thinking about it is you take the reverse repo, which again, remember, is a storage tank of excess dollars. Then you subtract the standing repo facility, which is again an emergency backstop facility that is there to provide dollars. So the reverse repo is there. It's a storage tank of excess dollars. So when that level's higher, it indicates there are more sterilized dollars that can be brought into the financial system and into the economy. Well, the standing repo is indicating the exact opposite, which is you have to go to this Fed emergency facility to get the dollars that everyone so badly needs. We see this spread going negative for the first time since 2020. Here again is a way to think about these repo markets. The discount window rate in blue, this is the Fed's attempt at setting a ceiling in the price of money, saying no matter how scarce dollars get, we will always provide them or sell them at 4.25. The reverse repo award rate here in red, that is the Fed saying no matter how overabundant dollars get, we are always going to buy them at 4. Right now, the interest rate there is 4%. So this is how to kind of think about it. We now see that SOFR, which is the free market supply and demand $4, based on supply and demand $4 loans in the repo market, SOFR is now notably above the discount window rate, and it is not quarter end or year end. Now, again, we have data for Friday, so we can examine this on a weekly basis. This is the highest weekly spread going all the way back to March of 2019. By the way, you can't even see the repo rate crisis on the weekly because it was done and over so quickly. The Fed responded so very quickly to the repo market crisis of 2019. Again, the way that they would fix this is by printing bank reserves and then injecting them into the financial system by buying U.S. Treasuries and mortgage-backed securities from the banks. That is the way of injecting the new freshly printed dollars into the system. So if we go to the Fed's website here, we can actually see that the vast majority of the standing repo is not working here for me right now. The vast majority of the standing repo was actually using mortgage-backed securities, which might be important. It was not actually U.S. Treasuries that were pledged as collateral for that standing repo. It was mortgage-backed securities. Of course, we know going back to 2020, there was a significant weakness in the mortgage-backed security market. Here, we're looking at SOFR minus the Fed funds, yet another way of thinking about SOFR relative to what the Fed would like the interest rate on an overnight basis to be. Here, we're looking at the daily chart, and of course, you see other spikes. Well, of course, in 2020, we see a notable spike, but then you also see a spike here at the end of September and at the end of December as well. So year end for 2024. But again, it is October 16th, yesterday, when these started to blow out. And today is October 17th. So not tax deadline, not quarter end, not year end. There's no window dressing or anything or any tax implications. There's no real reason why there should be a shortage of dollars in the system. So again, just to remind everyone why this is happening, we are running very, very large fiscal deficit. Remember what this means. The government is spending more than it collects in revenue. Right now, that deficit is about 7% of GDP, which is just unheard of outside of a recession or a global war, some sort of geopolitical major conflict. We have been running this pro-cyclical deficit. As you can see, the deficit has gone from a 2% surplus in 2001 to now a 7% of GDP deficit. And of course, if we look at the unemployment rate, which it generally follows the deficit, again, you run a large deficit during a recession, and then it improves as the unemployment rate comes down, as the economy starts to strengthen. Of course, we are running a pro-cyclical deficit of 7% of GDP, meaning the government, the US Treasury, must issue every year 7% of our total economic output must be issued and then bought by the bond market with dollars, equaling 7% of the US total economic output. Now, other negative liquidity factors are here. The TGA, the government's checking account, the TGA, they have been rebuilding this back up from a low of about 300 billion to now about 810 billion. What that means is 500 billion, so $500 billion, had to be removed from the financial system, from the economy, from the banking system. And we can see that reflected as bank reserves have declined quite sharply, now right around $3 trillion. Now, in addition to that, as we mentioned, the reverse repo, which is a storage tank of excess kind of sterilized dollars, that is empty. So there is no storage tank you can go to tap. Think of the reverse repo as a shock absorber. In and of itself, it's not necessarily a major factor in liquidity, but recently, since 2020, it has been there and kind of acted as a buffer or a shock absorber for negative liquidity strains, right? Back here in 2023 in the summer, Janet Yellen built up the TGA, but look, there was this excess, this tank of excess dollars that could be tapped, right? $1.8 trillion when she started that rebuild. Now, there is no such buffer for them to tap. And of course, the Fed has been engaged in quantitative tightening, meaning, of course, they are reducing their balance sheet, which has a negative effect on bank reserves. So just like QE, which, by the way, here we can see the repo market crisis, they immediately increased bank reserves, again, injected those into the system, freshly printed dollars, by buying mortgage-backed securities and U.S. Treasuries. So that is how the freshly printed dollars get injected into the system. They responded immediately back in September of 2019 to the repo rate crisis. If this continues to get worse, I expect them to do the exact same thing. Now, how much of the regional bank issue is tied to what is going on in the repo market? I'm not smart enough to say. It's got to be somewhat related. So it is probably not a coincidence that repo market stress and funding stress in the repo market is getting, liquidity is getting so tight. And what do you know? Just a couple days later, you have these massive issues with the regional banks. It's got to be somewhat related, at least intuitively. But again, I'm not a banking expert. I'm not familiar with the particulars of the leveraged loan market or anything like that. But certainly something to keep an eye on. And again, I would keep an eye on LQD divided by HYG. This is investment grade corporate bonds divided by high yield corporate bonds, and they are a good proxy for credit spreads, and again, are updated more frequently than the B of A high yield option adjusted index. I did a video on credit spreads a couple days ago, so I will link that here at the end if you have not seen it. Credit spreads are incredibly important at indicating not only liquidity issues, because a large degree of credit spreads is tied to liquidity conditions, which we know are deteriorating, but also, of course, the creditworthiness of the difference in creditworthiness and default risk between two different groups. Sometimes you can look at investment grade relative to junk bonds, junk corporate bonds. Sometimes you can look at U.S. Treasuries related to investment grade or U.S. Treasuries related to high yield. There's a number of ways of thinking about credit spreads, but again, they kind of generally reflect liquidity conditions and, of course, default and creditworthiness, credit risk, kind of broadly speaking. So anyways, a couple things to keep an eye on. SOFR is getting worse. The repo markets are getting even tighter than they were yesterday. And of course, the regional banks are just absolutely plummeting, with the largest daily losses sometimes going back all the way to the regional bank crisis of 2023, when we had 3 of the 4 largest bank failures in U.S. history. So certainly cause for volatility, cause for caution. Again, I would say watch credit spreads, and we'll continue to update on the repo market if we see anything further. Hopefully that was helpful, and I'll catch you in the next one.